how do you set up the right entity for your business? I mean, the entity that gives you the least amount of liability, that's best for tax purposes, that's best for business credit building. And once you do that, then how do you go about getting the other numbers that you need? Your BEN number from Experian, your DUNS number from Dun Bradstreet, your EIN number. There's so many things you need to do to set up your business initially to be fundable. And if you get this right, then it's way easier to get approved for credit cards, credit lines, and loans. And it's easier to get approved for the most amount of money at the best terms. And if you get it wrong, then you're going to be denied all over the place and not know why. So today we're going to decode this whole thing. I'm going to break down everything you need to know about entities, the different entities that are out there. A lot of surprises you're going to uncover along the way. Help you set up the right entity, change your entity to the right entity if you're set up incorrectly now. Get your entity set the right way if you are set up, and get you access to all the information on the numbers, the core numbers you need to do that make you look credible, that make you look fundable, that will help you get money for your business. We've got a lot to cover today, so let's dive in. Let's get going. Okay, let's get started with talking about the basics of business credit. So I like to start off here because when we talk about fundability, business credit is one of those core components of fundability. And when these things are done right, setting up an entity, setting up the right kind of entity, getting your EIN number, getting your DUNS, it makes this much easier. It helps unlock funding. It helps your business really fund itself, where it can actually get credit that's linked to your EIN, not your social. But you can't do that without certain things. So when we talk about fundability, we're talking about the things that make you lendable. So here's what happens is the vast majority of applications in this country, it's estimated over 80% get denied because of fundability factors, not because of qualification factors. So let me restate that. Over about 8 out of 10 applications for funding are not denied because you don't qualify. They're denied because you actually aren't meeting basic requirements that lenders and credit issuers have. If you make some changes, you would qualify. This is why the majority of applications are denied. And the reason for that is that lenders are trying to fight off rampant fraud. They're trying to make all these determinations to see if your business is even legit and credible. And if there's a lot of things you don't do right, then they don't see you as legit and credible, and that's why they deny you. But here's the miraculous thing, is that when you fix these basic things in fundability that lenders and credit issuers want to see from you and your business, then it all turns around, and then you have a much easier path to get the money you need at the rates and terms that you really want to get, okay? So today we're going to talk about several things. We're going to talk about business entities, setting up the right entity, all that you need to know about entities to be able to choose the right one. We're going to talk about other numbers that you need to get access to, EIN number, BEN number. There's an Equifax identification number as well, DUNS number. We're going to talk about a lot of these things that you need to do that make you look credible so you can set your business up the right way. Now, your business entity does matter. It has to do with a lot of things. The main things that business entity affects you with is your taxes, what you're paying on taxes, how your taxes are set up. Are you double paying taxes? Is your business paying taxes? Then you're just paying taxes. Are you paying half the taxes that you should be? The other aspect is just liability. When we talk about building business credit, we talk about building credit for your EIN that's not linked to your social. This is credit you can get without a personal guarantee. That means you're not personally liable. But here's the kicker. If you get business credit, do it right, and you have no legal liability there for the debts, if you set up the wrong entity, you're still liable because you set up the wrong entity. And other things like LLCs aren't even entities when we think we are. There's a lot to unpack here with entities, and you got to get that done the right way. If you do that, then you set it up the right way, then it really puts you on a path to be able to get the most money at the best terms. So here's the actual entities recognized by the IRS: sole proprietorship, partnership, corporation. Really, those are the main three. Is sole proprietorship, partnership, and corporation. A corporation is split into a C Corp or an S Corp, and we'll talk about both of those today. Now, an LLC, you notice, it's not considered an actual entity. As a matter of fact, I just went and set up an LLC in Montana yesterday for completely different purposes to do with my vehicles. And in doing so, the first thing it asked is, okay, now that you filed the SLC, which of these entities do you want to file it as? Do you want to file it as an S Corp, a C Corp, a partnership, or do you want to file it as a sole proprietorship? So you'll even notice that an LLC is not an entity. If you go to set it up, it's actually going to ask you what kind of real entity behind the LLC you actually want to have. And we'll talk a little bit more about that today as well. Sole proprietors per SBA, this type of structure can be a good choice for low-risk businesses and owners who want to test their business's idea before forming a more formal business. Now, first of all, before we dive into this, let me say I'm not an accountant, and this is not accounting advice. I'm not an attorney, and this is not legal advice. This is coming from 20 years plus in the finance industry. And what you need to know about entities as it ties into helping you get more money for your business. So this is the IRS and how they see it and what's in or per SBA. And what's interesting about this per SBA is that you see some interesting terminology here. So it's a choice for low-risk businesses and owners who want to test their business idea before forming a more formal business. So this is basically even telling you they don't really consider sole proprietors as serious entities. And this is what SBA is saying. Hey, this is more for owners who just want to like test the business idea before setting up a real business. So you need to know this. It's okay to start as a sole proprietor, but it's not really seen by SBA, lenders, credit issuers as a real legitimately credible business entity. If you have this, it really makes it look like you're just test driving the business. You're in the infancy stages of it. You're not really even taking your business too seriously. Okay, and this isn't my opinion. This is how lenders and credit issuers and SBA even look at this. So you've got to be careful. You can start with a sole prop, but you probably don't want to stay at a sole prop because it's just not taken seriously when it comes time to getting money to expand your business. Now, partnerships are limited partnerships and limited liability partnerships. Limited partnerships have only one general partner with unlimited liability. All other partners have limited liability. Okay, and you can learn more about that at SBA.gov. With limited partnerships, partners with limited liability also tend to have limited control over the company, and the general partner, the partner without the limited liability, must pay self-employment taxes. Limited liability partnerships are a lot like a limited partnership, but they give limited liability to every owner. An LLP protects each partner from debts against the partnership. They will not be responsible for the actions of other partners. So look, there's a lot of areas where you kind of have to have partnerships, attorneys, doctors, these kind of things. If there are multiple owners, they're kind of they're kind of pushed this way because of liability reasons, because with malpractice insurance and all these other things involved, they kind of have to be. So they are liable for what's happening in the business. So when you look at partnerships, it really comes down to liability, the type of partnership you actually have. You can have multiple partners, but in that arrangement, who is liable? Who holds the liability? Both, one person who holds more liability. You've got to figure that out to determine the kind of partnership structure you really want to set up. Now, C corporations have a completely independent life separate from its shareholder. Its shareholder leaves the company or sells his or her shares. The C corporation can continue doing business relatively undisturbed. Corporations have an advantage when it comes to raising capital because they can raise funds through the sale of stock. They can also be a benefit to attract employees. Look, if you look at the most reputable, credible entity type you can set up across the board, it's a corporation and it's a C corporation. This is what, I don't know, almost every major big company is at, is a C corporation. And there are negatives, and we'll talk about some of those negatives. But this is the one where you can be an owner, you can be a shareholder, you could sell your shares. The entity still functions, it still moves on without you. Okay. And the other thing is that this is kind of the way it's done with bigger entities, because the profits of the business, the losses of the business aren't rolling over to your personal taxes. That doesn't happen with real, legitimate, privately owned, publicly owned big businesses. So C corporations where you eventually want to graduate to, more than likely, as you become a bigger business. And Richard says, good day. Let's get some good gems today. I'm hoping to give you some gems. So we'll see. Thanks for tuning in, everybody. And if you're getting value here, do me a favor, just hit the like button, hit the love button, share this. Let's get this out to as many entrepreneurs and help as many people as we can. Okay, so corporations can be a good choice for medium or high-risk businesses. They can be for businesses needing to raise capital. They also can be good for businesses that plan to go public or eventually be sold. So let's think about this. We're talking about setting up a C corporation to make sure it's easier to exit, to sell the business, to sell your shares, to get out, to raise capital, right? To go public. These are really big moves: going public, exiting your business, raising money. And this is the preferred entity type for that. So the reason I tell you that is that's how credible C corporations are. Like when you really want to make big moves in your business and build a big business, you build a C corporation typically. Raising money, going public, right? Exiting your business. This is where this looks at as more credible, not just in all these situations, but also with lenders and credit issuers as well. Now, an S corporation is a special type of corporation designed to avoid double taxation drawback of regular C corp. So what do we mean by this? What I mean by this is that when you have a C corporation, okay, you are an employee. So a C corporation, the corporation pays taxes. So the corporation pays taxes every year to the IRS. Then what happens is you're an employee, and you as the employee pay taxes as well. This is where we look at what's called double taxation, because the entity itself is paying taxes, then you get paid money, then you have to pay taxes too. So it's really double tax. The business had to pay taxes, then pay you, and then you have to pay taxes. So that's what a C corporation is. An S corporation helps avoid that double taxation. S corps allow profits and losses to be passed through directly to the person's interpersonal income without ever being subject to corporate tax rates. So what happens is with an S corporation, if my business makes money, the profit goes to me as an individual. It goes over to my personal taxes. Now, when I file my personal taxes, I'm taking into account the profit from the business that was passed to me, and I'm paying taxes once on that. So the nice thing about an S corporation is I don't have to have the business pay taxes, then pay me, then I pay taxes. What happens is the business's profits get carried to me as an individual, then I pay taxes once on my own personal income from the business and the actual profit that was moved to me as well. Same thing with a loss. So that's ultimately the difference. C corporation, you get business gets taxed, then you get paid normally, you get taxed. S corporation, business has profits, business has losses, that passes down to you as the owner, and you only pay taxes once on those profit or losses and on how much you get paid. So where is this needed? Well, S corporations are a really good place to start if you just start a business. If you don't yet have a bunch of employees, if you're not big yet, if you know you will be, well then, or you think you will be, start with an S corporation. And then that way you don't have double taxation when you're building the business, and it's really important to have as much money as you can. And then as the business gets bigger, you can then switch it to a C corporation. Question I get all the time. You can absolutely switch entity types. You don't have to start a new business. It's different in every state that you may live in. So every state's a little bit different. So typically go to your accountant or go to your Secretary of State, and that's where you can get the instructions to do this. So sole proprietor is the same as the owner. The owner pays taxes on the sole proprietorship's profits. A partnership does not have to pay income tax. Instead, the business will pass through its profit or losses straight to the partners, much the same as we talked about with an S corporation. Then the partners will include their representative share of the partnership's income or loss in their personal tax return. So it's very different on how they pay taxes versus sole proprietorship. Now, a corporation pays state and federal taxes. They sometimes also pay local taxes. This will also include paying income taxes on profits. It's the opposite of a partnership and sole proprietorship. So in this case, when we look at sole proprietorship, when we look at partnership, it all kind of comes down to the individuals. It's the taxes basically get pushed to the individuals and the entities. But with a corporation, especially a C corporation, the corporation's paying its own taxes. The taxes that need to be paid don't get passed down to the individual. So an example here is just let's look at Credit Suite, right? Credit Suite's a C corporation. Credit Suite makes money this year, makes money last year, and has to pay taxes. Let's say it's $200,000 in taxes that Credit Suite has to pay. Well, that's the company that writes that bill. The company's the one that has to pay 200 grand. If it was a sole proprietorship or it was a partnership, well, then that would come down to me. I'm the one writing the check to the IRS. So it kind of gives you an idea of the difference there. Now, a corporation can end up paying taxes twice. First, when it makes a profit, and the second time when the dividends go to the shareholder. This is the case even if there is just one shareholder. So again, you can pay taxes twice. Now, if you have a good accountant, there's a way around this. You don't have to do it as dividends. You could do it as maybe some distributions. You could do it as bonuses. You could do it all different ways. But it is, if you're looking at dividends, the way that it is. The corporation pays taxes. Then when it comes time to pay dividends to shareholders, there's taxes there as well. So things to keep in mind. Doesn't mean you avoid corporations. It just means you have to look at dividends other ways, whether it be distributions, whether it be whether it be done through bonuses, etc. It's just something you want to bring in an accountant into because they're definitely going to help you figure that out. Now, S corporations are also called subchapter S corporations. And the reason for that is that subchapter S is actually a section of the IRS code called subchapter S. That's why it's actually there. Only the wages of any S corporation shareholder who is also an employee are subject to employment tax. Okay, and any remaining income is paid to the owner as a distribution. Distributions are taxed at a lower tax rate, if at all. So again, when you're an S corporation, it just makes sense to start a business entity off as an S corporation and then eventually go up to a C corp. An LLC is not a separate entity as per the IRS. Okay, so it's not taxed. Instead, the members pay individual taxes, and members of an LLC pay an employment tax on the entire net income of the business. Okay, so that's how it actually works. So a lot of people think an LLC is an entity choice, and an LLC is absolutely not an entity choice. If you go to set up an LLC, they're going to ask you what entity you want behind it. Okay, so I, for example, have an LLC in Montana. And the reason I do that is, well, for a lot of different tax benefits and a lot of different reasons, but Montana, you don't have to pay sales tax. Okay, Florida, we make all of our money in Florida based on sales tax. I don't have to pay state tax here. I don't have to pay state tax because tourism brings in so much money in sales tax that it helps us. But if I go to buy houses, if I go to buy vehicles, if I go to buy airplanes, whatever it is, man, I take a major hit on taxes here because the tax to purchase something is 7%, my sales tax. I don't know why I forgot the name of sales tax, but I did just for a moment. But in Montana, you don't have that. They don't have sales tax. So again, there's different reasons you might want to set up LLCs or different entities in different states for different tax benefits. It depends on what your attorney advises. But in this example, an LLC, I've got to choose the entity behind it. If I'm choosing an LLC, I chose a C Corp behind it. Okay, so again, the entity I choose determines how I'm taxed because the LLC isn't an actual real entity itself. So sole proprietorship, but there's no limits to personal liability. If the sole proprietorship did, then if the sole proprietorship did it, well, then the owner did it. Okay, includes all debts and obligations. So what this means is if the entity gets sued, the business gets sued, you get sued. You are the business. This is sole prop. Like you're one and the same. If the business defaults on a credit card, you defaulted on the credit card. It's one and the same. So you're liable here for everything that happens in the business. You are the business. So again, I'm not an attorney, not legal advice, but this is why you want to avoid sole props, because any debt in the business that defaults, you're personally liable for. Okay. And on top of that, you also have the problem if the business gets sued, you get sued. As a matter of fact, if you ever have to shut down the business, you have to file a different kind of bankruptcy as a sole prop because you're personally liable for all the business debts. It's not like you could just bankrupt the business and move on. You're still personally liable there. So there's like a whole special kind of bankruptcy you've got to file even as a sole proprietor because you're personally legally liable for all those things. Now, partnerships retain full shared liability. Therefore, partners are not only liable for their own actions, they're also liable for any business debts and decisions made by the other party. Plus, all the partners' personal assets can be seized to satisfy a partner's debt. So why do partnerships exist? Well, a lot of times they have to. Some of the most common places we see partnerships are doctors and attorneys. And in a lot of cases, they're required to have this certain entity type they set up because they need to be liable for what happens in the business. It has to do with malpractice insurance and the type of insurance that they have to carry. So sometimes in some entities, or industries, you kind of have to be in an entity where you're personally responsible because they want you to personally be liable for the decisions you're making in the business. In other cases, you have a choice. But you need to know here that partners are equally typically liable depending on the type of partnership that you set up. Now, within a corporation, the shareholders' personal assets are protected. Shareholders can usually just be held accountable for their investment in the stock of the company. But if an employee commits fraud or felony under the corporate's directive, the corporate veil can be pierced. Then personal assets can be on the line. So again, the nice thing about corporations is that my assets are protected. If Credit Suite ever, goes to bunk and we close our doors, God forbid that ever happens, right? They can't come after my personal assets for any debts that we may own. Now that's a crazy situation because we don't really hold a lot of debts. We pay off whatever it is that we borrow fairly quickly. If we do, if we do need to borrow. But again, the point comes down to the fact that my assets aren't exposed. And this is something very important because this is why I started teaching about business credit. I lost everything in the mortgage crisis. I didn't see that coming, the same as a lot of us didn't see COVID coming. And it's an industry killer. That was like that killed the industry short term. This is an industry killer with COVID to a lot of different industries. So the bottom line is you don't know what's happening. You don't want to be liable for business debts if you don't have to. This is why you really need to choose wisely on the kind of entity that you set up. But even here, we see this all the time. We see CEOs of big company be sued personally. Okay, not just for money, but to go to jail because they do fraud. They commit all these treasonous acts. And I remember the story of the lady that I think with a fingerprint could tell you all this information. It was all fraudulent. It was all fake. So it's not like you can hide behind a corporation and do shady things. You can still be convicted. You could still go to jail. You could still have personal liability if you commit fraud, if you commit felonies, if you do other things as the leader of that business. So S corporation shareholders' personal assets like personal bank accounts cannot be seized for the purpose of satisfying business liabilities. LLC members are protected from personal liability for the business decisions or actions of the LLC. The LLC incurs debt or is sued. The members' personal assets are often exempt. So again, but not always, hence the term limited liability. So again, S corporations, C corporations, LLCs, we see this trend of having a greater ability to protect our personal assets, which is one of the reasons we want to go with these entities. Now, sole proprietorship, the owner is the company. it makes the money. So the owner is 100%. It makes that money as well. Partnerships, partner shares vary, and they should be clearly spelled out in the partnership agreement. An LLC is another type of corporation, and then the only real difference is liability rather than shares and cost. So it works very similar to other corporations, okay? So a corporation is run by its board of directors, usually the owners. Ownership stakes are defined by what percentage of stock everyone has. If one person has a controlling interest over 50%, then their decisions will generally overrule everyone else's. So if we look at Credit Suite, for example, I've got a partner with Megan. Megan is my partner. She's the COO. And how we split that up determines who has the actual final say in things. Now, this isn't really a big factor for us because Megan and I have never had a disagreement where that ever's come up in the many years that we've worked together. But you should have that. You should have a controlling party to settle agreements, because you're not going to always get along with your partners. Okay. Now, again, a corporation is run by its board, as we talked about, and ownership stakes are defined by the percentage of stocks everyone has. So it really comes down to how much ownership stock or ownership interest you have in the business. You own 30%, 50%, 60%, et cetera. Now, the shareholders have smaller stakes in the corporation. Sometimes they'll band together to influence decisions or even kick out other board members. So if you have 30% control, and there's two other people with 30% control, one other person with 10, I guess, in that case. Well, those other people can band together and outvote that one person. So some things to keep in mind, depending on the shareholder agreement, right? We can have 3 equal partners with 33 1/3%. And then 2 of them don't like the decisions one's make, and they band together and basically outvote the other person. So some things you have to keep in mind when you're putting together a shareholder agreement. You want to build in some language about what happens if there are disagreements. What happens? Who can one person be outvoted by the others, for example? Okay, profits are generally distributed per share percentage, although board members can take a salary. S Corp's a shareholder working for the company must pay him or herself reasonable compensation. So some other things here. Firstly, how are profits distributed? Well, you determine that. So you could put together a shareholder agreement and say, hey, this company is going to retain 60% of its profits. 60% of whatever the profits are stay within the company. And then it's used for reinvestment within the company. But 40% are distributed to shareholders. So maybe once a year or twice a year, you look at how much profits are in the business and you take out 40% in that example and distribute it to the shareholders. How it's distributed depends on who has what percentage of shares. If I take out, if I do $100,000, I take that out in profit, okay, and that gets distributed to shareholders, and I have 50%, and somebody else has 50% ownership, well, then we both get $50,000, right? If I have 30% ownership and somebody else has 70, well, then I get 30 of that 100, and they get 70. So a shareholder agreement determines what percentage of the profits stay in the business and come out, and then it's typically distributed based on what percentage of ownership interest you actually have in the business. Now, Bridget says, I have an LLC series in Delaware. Do I need to add an S Corp behind it? You don't. But when you set up that LLC, if you remember, they more than likely asked you what entity type you want, because you have to have an entity for an LLC. An LLC isn't its own entity. So that's probably what happened. If you can look back at your paperwork, you'd see that. Richard says, so does the company have a program that will assist in setting up your LLC correctly to build your own business? We do. We even have sources that will help you do that for free. So when you're working with Credit Suite, we help you go through all aspects of setting up your entity, getting your EIN, getting all these numbers. And we've even got sources that can help you set up an LLC for you at no cost as well. So something to consider. So again, now back to the next point, S corporations, a shareholder working for the company must pay him or herself reasonable compensation. This is a problem. So a lot of us as business owners, we want to get paid 1099. We don't want to pay ourselves. But the problem is when your business gets bigger, you have to pay yourself. You have to. The state will want to come in because they want state tax. The government will step in eventually if they see the company's getting bigger and there's nobody there that's actually pulling out a salary. So it's going to happen. Now, the shareholder has to get fair market value, or the IRS may reclassify any additional corporate earnings as wages. So again, what happens is as the business gets bigger, if you don't pay yourself, you're paying yourself under the table, whatever it may be, it's going to be a problem. Because the IRS and the state's going to recognize that nobody there is the leader of the company that's getting paid a salary. Then what happens is they can come in here and reclassify part of your income as actual wages, and you could possibly be double taxed. So you have to keep that in mind. At some point, your accountant's going to tell you your entity's getting too big. You need to make sure you're legitimately paying yourself. So in Credit Suite, for example, I am a W-2 wage earner. I get paid a W-2. I get a paycheck like everybody else. Taxes are taken out of my paycheck like everybody else. I get a W-2 at the end of the year. I file taxes just like everybody else. My taxes are just as simple as somebody that works any other regular job, okay? I mean, well, not really, because I own a bunch of different businesses, but my businesses are all done in a way. Anyways, I won't even get into that. My businesses are all done in a way where a lot of that doesn't trickle down to my personal income. The bottom line is, from Credit Suite, I get a W-2. I get paid as a W-2. I get taxes taken out of my paycheck just like any employee does. Eventually, you have to get to that point in the business, or it creates those kind of problems. So is it possible to choose the wrong entity? Well, unfortunately, it's all too possible to choose the wrong entity. A lot of businesses start off with sole proprietors, but there's no separation between them and the owner. Partnerships are another entity where the ownership and the business are more intimately connected with either entity, and all efforts, other efforts of separating business and personal credit could be all but for naught. And again, you can't build successful business credit if you are personally liable for your business debts. You could build it, but the not being personally liable for your business debts part goes away if you choose the wrong entity. So when it comes to choosing the wrong entity or right entity, it comes down to two things: how you're taxed and how liable you are. And that's what this whole training is all about. I showed you, hey, here's how each one's taxed. Hey, here's each one and how liability works. And those are the two things that matter the most, is what kind of liability you have as the owner and how your taxes are paid. And again, I've given you a lot of training to know the difference there, but an accountant can definitely help you, at least when it comes, and an attorney on the liability side and an accountant on the actual taxation side. So a corporate structure truly separates business and personal finance. It is the best way to go, because a corporation is considered to be its own entity. So whether you choose an S Corp or a C Corp, well, that's really up to you to decide. It depends on whether you want the profit or loss of the business to carry over to your personal taxes or you don't. Okay, we started Credit Suite from the beginning as a C corporation because we knew it was going to be big in a very short period of time. Okay, and our accountant at the time said, you're going to get double taxed. I said, yeah, but we're going to build this really quick and it's going to be really big. And as a result of that, I don't even want to have to go from an S Corp to C Corp. I want the profits and loss of this business nowhere near my personal taxes. So I immediately started Credit Suite as a C Corp. But I started many businesses before it as an S Corporation, where it did carry down to my profit. So it's up to you, but I have found historically that when a business is small or may never get big, I keep it as an S Corp. It's no big deal. If I know from the beginning it's going to get big and it's going to get big fast, then I go to a C corporation. That's personally how I do it, but you have to make your own decision there. So we highly recommend working with a corporate attorney to help with that. An accountant will help you with that as well. Okay. Once you're done getting your entity set up, you want to go to the EIN and go to the web irs.gov and get an EIN set up with them. The Internal Revenue Service gives a brief definition of each structure to help you once you actually file that EIN. The further you go into the form, the more information the IRS offers. But again, you only can get a free EIN from the IRS. There's a lot of places that mimic themselves and make them look like the IRS. Then you go all the way through the process and they charge you a fee. You never have to pay a fee for an EIN number. And yeah, you do need to have an EIN number to build business credit. And it goes a long way to fundability. You just don't look legit if you don't have an EIN number. Now, you might say, Ty, I don't even think you can have a business without an EIN. You can. You could be a sole proprietorship and not have an EIN. So you need to make sure you get the EIN. It's free from irs.gov, and it is how our IRS, how banks, credit issuers really see you as a legitimate business because you have an EIN. Now, a benefit corporation, sometimes called a B Corp, is a for-profit corporation recognized by most states, and they're different from C Corps in the purpose of accountability and transparency, but there's no difference in how they're taxed. So shareholders hold the company accountable to produce some sort of public benefit in addition to financial profit, and some states require B Corps to submit annual benefit reports that demonstrate the contribution to public good. So think about nonprofit. Nonprofit has certain exemption status because it's not out there to generate a profit. It's typically out there to help in certain things like charities. Well, a B corporation, which most people don't even know exists, it's kind of it's a corporation, but it also has this public benefit aspects to it as well. So these are becoming more popular as we now see more and more businesses are choosing a cause, choosing a purpose to really jump all in on. So closed corporations are like B corporations, but with a less traditional corporate structure. They do not have all the formalities that usually govern normal corporations. State rules vary, but shares are usually barred from public trading. And closed corporations can be run by a small group of shareholders with no board of directors. So some things to keep in mind there. Now, it's not required you have a board of directors. Okay, we don't have a board of directors at Credit Suite, so it's not required, but some things to keep in mind. Typically, a C corporation will eventually have a board of directors. Nonprofit corporations are organized to do charity, education, religious, literacy, or scientific work. Since the work benefits the public, nonprofits can receive tax-exempt status. This means they do not pay state or federal income taxes on the profits they make, and nonprofits must file with the IRS to get tax exemption. And this is a different process from registering with a state where they're located. So, obvious benefit here, you don't have to pay taxes as a nonprofit. It's why people go and fight so hard for tax-exempt status, because as your business gets bigger, taxes can account for hundreds of thousands or millions of dollars a year. So again, to get your EIN, you go to irs.gov. It's free to get. Other numbers you need to know about. Dun's number is one of them. It's the number that identifies you worldwide with Dun Bradstreet. This is used by the Australian government, the U.S. government, the UN. It's used for being a contractor for the government, a lot of different things. So you should get this. It's 100% free. Go to creditsuite.com/Duns to get it. creditsuite.com/Duns. Equifax has an Equifax ID. The Equifax ID number will automatically be assigned to you the minute you get your first account reporting to Equifax. So as you start building business credit, the minute your first trade experience or trade line reports to Equifax, that will then generate your Equifax ID with them. And Experian has a BIN number or a business identification number. Same thing happens. The minute Experian creates a credit report for you, which is typically when a trade line reports to them, or when they know you exist because you file annual reports and they know your name, business name, your location, and your actual NAICS code or your industry code. If they know those three things, they'll populate a report and a BIN number for you automatically, or it will happen whenever you get accounts to actually report to Experian as well. Okay, and Aisha, I think that's pronounced right. Circulating back really quickly. Is it difficult to become a W-2 company? Probably worded that wrong. Well, W-2 is how you get paid. It's not the type of company you are. So it's not hard to set up any entity type. You go to your Secretary of State, you choose your business name, you choose your entity type. If you've already chosen an entity, then you go to irs.gov, get your EIN. If you've already chosen an entity, then you can go back and change entities to a different type fairly easily. You might want to get with an accountant. They can help make that easier for you as well. The W-2 company or W-2 employee, that's how you're paid. And that's just as easy as well. You can start paying yourself through W-2. There's a lot of different payroll companies out there that can help you with that as well. Just keep in mind that taxes come out of your paycheck the minute you start doing that. A lot of people like to pay taxes at the end of the year when they file 1099 as W-2. They come out like every pay period. So some things to keep in mind. So again, we talked about the BIN number, we talked about the DUNS number, we talked about EIN as well. So in order to make your business fundable, as we do a recap, you got to choose the right entity. And the entity really comes down to legal liability of the debts in the business and other things, and getting sued, et cetera. And it also comes down to taxation. We talked about all these different entity types and what you need to know about both. Okay, liability, taxes, cost, and shared when there's multiple partners involved. Those are the main reasons you choose the entity you choose. Hopefully you now have enough information to choose the right one. Don't forget, a good tax accountant or an attorney can help you with the entity you choose. Okay, and an actual accountant can, an accountant can help you with the entity you choose, and an attorney can help you advise you on the liability side. Don't forget a DUNS number. You do want to go to creditsuite.com/DUNS or DNB.com to get your DUNS number set up. Experian BIN number, Equifax number will be assigned to you automatically the minute they know you exist and populate a credit report for you. If you want to learn a little bit more about where you stand fundability-wise, give us a call. On a free consultation, we'll do a fundability assessment. We'll do a Secretary of State check. We'll see what's messed up with fundability you need to fix and help you with the process of improving that. We'll help you get your business credit reports with Dun Bradstreet, Equifax, and Experian for free to see what's on those and go over those and give you tips and tactics to build your business credit. We'll also do a funding assessment to talk to you about all the loans and credit lines you can get now 100% free on a consultation. Give us a call at 877-600-2487. That's 877-600-2487. Email info@creditsuite.com or go to creditsuite.com/consult, creditsuite.com/consult to schedule that consultation. And you get value. If you got value from today, just hit the like button, hit the love button. That's all I ask. Hit the like button. There's one little step, but that helps the social channels know this content's valuable and show it to more people. And that means a lot to me because I like to help as many people as I can possibly help. Okay, so make sure you like and make sure you subscribe on the channel you're watching on. If you're watching on YouTube, you can click subscribe, click the bell. Besides subscribe, select all to get notified whenever we release new content. And don't forget, Tuesday and Thursday at 1, 11 o'clock on Wednesday, all Eastern time, we go live on Facebook, LinkedIn, and YouTube to teach you more about improving your fundability, getting business credit, and getting financing as well. And don't forget to follow us on our other channels. Top right of our page, creditsuite.com. We have daily tips on Instagram, Facebook, Twitter, hundreds of videos on our YouTube channel. Our podcast has 500,000 downloads because we have all kinds of special guests come on that teach you the aspects, the fundamental aspects of building a business. All of that happens on our podcast, and all those social channels are available at the top right of our page, creditsuite.com. And Aisha, I think I pronounced that right. I apologize if I didn't. That's good. I'm glad that you got value from that. And Lydia, thank you so much for all your valuable information. Thank you. Thanks for tuning in. Thanks for liking and subscribing. Don't forget to give us a call for your free consultation. And I look forward to seeing you in our next training. We'll talk about more cool ways to get money to grow your business.